I'm Peter Reznachek from ShadowTrader.net, and this is the weekend edition. I purposely wore the red shirt today. It's the only red shirt I own, but I had to wear it for this particular show because the selling intensified a bit this week. And if you recall, we've been talking about a very rotational market up until this week, and that has changed. So we're going to delve into the details of that in this show. Lots of charts, lots of things to talk about. Really excited. As always, kicking it off with the charts, finding out what's really going on. As we were discussing in the introduction, things have changed a little bit in that the selling was a little bit more broad-based. We want to take a look at our charts, not just in the cash market, but I want to show you some key levels in the futures market as well today that'll give you a better idea of where we are currently and where we might be heading. Let's shift over the charts here for a second. We're going to kick it off on the S&P Daily, as we always do. If you recall, in prior shows, we've been talking a lot about short-term moving average support, namely the 8 and the 21 exponential. Those are my main moving averages. I really only use two. As I always say, I think people need to keep their TA as simple as possible. Get all that stuff off your charts in terms of all of those studies on the bottom and multiple moving averages, etc. Pare it down to as little as possible, 1 or 2 moving averages and trend lines, and also horizontal supports and resistances. So that being said, we've got somewhat of a broadening top going on a little bit. You can see this channel, how it's kind of widening a little bit. I wouldn't say it's that wide, or I shouldn't say it's that broadening, but just something to notice. If this indeed turns into greater selling, I'm not really seeing that right now, but we'll get into that in a moment. But regardless, the key moving averages that we look at, which is the 8, that's the green dots, and then the darker solid line, which is the 21, both have been broken, and we have staged a daily close below both. So this kind of shifts the tone a little bit from more bullish to bearish. And obviously the shortest of the trend lines, like up here, what is the most short-term trend lines, those have been broken. Now, if you look at this S&P in terms of support, we're coming into a very key area here soon next week, and it's going to be very imperative to note how does the market act when it comes into this area. And by that area, I specifically mean this area here, where there was a lot of congestion. We talked about this a lot on this show, that markets only do one thing, right? They expand and contract from areas of balance to excess and back to balance. So when they're in excess, they're doing what we call price exploration, and all they're doing is trying to find new levels where they can be efficient again, right? A market that's moving fast in either direction, could be down or up, is not an efficient market. So this market is looking for the next area where it can balance out a little bit in price exploration currently to the downside. So I want everybody to pay attention to this area next week. Right now we're getting relatively close to maybe like the top of it. I mean, we kind of finished our day here on Friday right at the top of it. But I'm really more interested in the beginning, which is about 54.50 in the cash. And I'm going to show you the same level in the futures shortly. It also has a similar area with that same support there. But the 54.50 is pretty important here. We're at about the 5,500 key round psychological number right now in the S&P cash. Probably about 50 points lower is potential, I think, for next week where we could go. And again, supporting right around there at that 54.50 area. Shifting over to the NASDAQ 100 side of things, which is really much more important right now than it has ever been because it's so technologically driven, right? There's just so much tech here. There's a lot of tech in the S&P as well, as we know, like 32.5% of the S&P is now tech as well. We're going to be talking about that a little bit as well when we get deeper under the hood. But I'm such a big believer that when these markets are slightly disconnected as they are, it's oftentimes this technology driven index that kind of leads things a little bit. And you can see here on this chart that clearly the NASDAQ is already weaker because this is that same area of where the congestion was occurring in the S&P, and the NASDAQ has already moved down below it. The gap down here also is very, very important that it actually, when we gapped down big here earlier in the week in Wednesday, we went right to the top of this area where this congestion was, and that caused us to sell off a little bit, and you can see now we've retraced that whole area. I'm not really calling for a trend line support here in the NASDAQ. It could happen, but it's quite a ways away. I mean, you're looking at a move down to about, let's say it's going to meet at around 18,800. That would be pretty devastating. I mean, that would be a pretty big move in the market. I'm not necessarily foreseeing that. My main takeaway right now is that Obviously, anything can happen from a news standpoint or catalyst. We never know when that catalyst is coming. We can't trade that way. I always say that that's akin to not leaving your house because you're afraid you're going to get hit by a car if you cross the street or whatever. So you can't trade that way. So something systemic obviously could occur, and I think that it would need that sort of a catalyst to really drive the market lower. What I'm seeing in this market thus far is really just very orderly selling. To that again a little bit, I keep alluding to talking about the sectors and different things like that, because you'll see that it's really more orderly. And when I say the word orderly, I just mean that it's not overly emotional and it's not overly panicked, right? And it's not the type of selling that is so deep where we're seeing breath readings at 15 to 1 negative, etc. It's not really that way. So what I believe is happening here in the markets is some froth is being taken off. Technology got a little bit ahead of itself. It certainly pulled away from the other sectors in the S&P by a lot because there was that huge divergence. Then we got into a more rotational trade over the last couple of weeks, and now we're seeing more broad-based selling. So just keep that all in mind. But regardless of that, NASDAQ potentially lower here, already at that support where I do foresee the S&P going. So it's really hard to say here what's going to happen with the NASDAQ going forward in terms of support, because there is a lot less. And this is one thing that has me thinking that there is potential for lower in the days and maybe weeks to come. Also is that if you look at this NASDAQ, since we're potentially losing the support area, look at what's happening here to the left. This is a relatively straight up move that also has large gaps, or I should say has this large gap inside of it. This was relatively emotional trade here, and that generally doesn't support as much. So you basically want to take it a day at a time. Keep an eye on all those market internals. See how the market is moving in terms of the 11 sectors in the S&P. What are your weighted A doing, iceberg tick, etc. All of those internals coming together so that you have an idea of whether or not contextually the selling is going to continue. I think right now there is a chance for that because contextually it is happening. It is happening slightly different from what we've seen prior, where we didn't see all the sector participating. Now it's more of an all-out move to the downside. In addition to the cash market, I wanted to spend a moment on the two futures markets that I watch most closely, that being the ES and the NQ. So we'll just start with the ES, just to illustrate once again that support level that's coming in around that 5440 in the cash, but it's about 5500 in the futures. This is going to be important, especially given that the futures, remember, trade 24 hours. So it is important to note that that area could get tested right in here in an overnight session. So just keep that in mind. You may come down to that support. So watch for that if that does happen. And again, that's the congestion area that we were talking about in the cash market. I believe this is probably where we're going. You can see this part here, which is the no support zone right here in terms of the futures, just being kind of a straight up move. We've already drilled through all of that. A lot of this also is speaking to that buyers shut off type of pattern. This is something, kind of a concept that I came up with many, many years ago. Buyers shut off is simply when you have one or two bars, generally one bar, that takes back multiple bars to the left of it. So in this case, you have multiple bullish bars up, but it only took a couple of bars to take it out. And we call that buyers shut off because usually the buyers are shut off above the tops of these bars. It just basically means that, to keep it simple, you can usually sell calls against those levels, because when you have that buyer's shut off bar that sort of engulfs many small bars next to it, it's very hard for the market to turn around quickly and get above those bars. So just something to keep in mind. So S&P, I think, does have potential for lower here, about 50 handles. And again, remember, this can happen in an overnight session, so be watching closely. I'd keep an eye on this on Sunday evening when they open and into next week as well, to see if that support around the 5500 in the ES does hold or not. I wanted to end the technical portion of the program here on the NASDAQ futures, but on a different time frame, on the hourly, just to illustrate one specific point. You can see here I've drawn a horizontal line across at a very key psychological level because it's such a big round number. That's the 20,000 level in the NQ, which are the futures that follow the NASDAQ 100. I wanted to point this out specifically because I think it's important to note, to touch upon what I was saying earlier in the program, that I feel like this selling is relatively orderly. And remember, orderly just means a lack of panic, a lack of real emotion, right? A lack of like everybody just dumping in a lot of fear, right? And this chart really illustrates that, because remember, these big round numbers are generally supportive. And in a market that's selling off relatively orderly, they're going to find support at those numbers, and then they're going to find resistance at those numbers on the way back. And over the course of this week, that's exactly what we saw in the NASDAQ 100. 100 futures. Notice that the sell-off here went to where? Right to 20K, right? Then you had overnight activity, had kind of sideways, wasn't able to break that 20K during that time. And then look what happened. You get the breach and you breach 20K and you come down, and then what? You rally back, and look what happened in all of these bars here. Sitting right underneath the 20K, and then even when you got here to an RTH session, where was the resistance? Right up at 20. So two takeaways from this. One, this type of selling is not overly panicky, because what happens when the market is just all out selling, everybody's completely stuck in the throes of fear, these numbers don't mean anything. So that's takeaway number one. Takeaway number two from this is the fact that if the NASDAQ futures at some point next week retake the 20,000, okay, that is going to be a very strong buy signal, at least for the short term, okay? If you see NQs hit the 20K, you should probably buy them, because obviously you have all of these people here that were trading underneath that are going to be wrong. They are going to have to reverse, and it is also going to be, you know, a retracement of a huge, basically choppy area. So that's wherever you have indecision. Remember, indecision leads to excess in the other direction. This is balance. If it goes back up, you probably see excess in the other direction. So I would say mark off that 20,000 in the NASDAQ futures for the near future, for next few days into this week. And if we do get back to that level again, I do think that is a buy in the markets. As the tone has changed a little bit this week, it totally behooves us to check under the hood and get back to those 11 sectors we've been talking about in prior shows in the S&P, and see how things kind of change this week as far as less rotational selling and more across the board selling. So I've got the graphic right here of just the last 3 days of this week snapshot. Remember, these are measured from the open, which is all that matters. I will go to my grave saying that it's the most important thing, and I think is the biggest travesty that all traditional financial media only speaks in terms of all pluses and minuses in the market in relation to the prior day's close. As traders, that doesn't mean anything, right? Remember, if there's a huge gap down in a stock and you weren't short it from the day before, what good is that to you, right? What does that help you that it's down $27, whatever? It doesn't help you at all, right? As a matter of fact, it's probably a buy over the first 1 minute high, over the first 5 minute high, or you probably need to be selling puts under the low or whatever, right? So it really has nothing to do with how much it's down from the prior day. It's all about what happens from the open. And so these are the 11 sectors that are making up the entire S&P 500, starting from technology, which is the heaviest weight, going all the way out to real estate, which is the lowest weight. You can see the percentages here. The first number is the percentage weight in the S&P. And what I wanted to point to is the difference between Wednesday, Thursday, and Friday. If you recall, Wednesday was in the market, started to go down. We traded on a gap lower, but look what happened from the open. People were still buying that market. You can see that even though the money was definitely going out of technology, and that's why in the prior segment I was talking about how it's so important to be watching the NDX and the NASDAQ futures here, because it's really, I think, somewhat of a leader of the market in either direction. Tech money was coming out of technology for sure, but look at the other sectors here, and some of these are very heavyweight sectors, such as financials, healthcare, and staples. Those make up a lot of the S&P. Real estate, not so much, but you can see it was a more rotational situation. But then when we get into Thursday and Friday, especially on Thursday, look at all the red across the board here in the sectors that make up most of the S&P. This is the heavy weights up here all the way out to communications. These are lesser weighted. But even then, notice that it wasn't so across the board, where there was still money going a little bit into utilities, a little bit into energy, but definitely a less rotational market than we've seen before. And then on to today, which is Friday. And I would say this was quite bearish in that you have only healthcare, which was basically flat. You can see it's 0.03, like 3 basis up from the open at the close, but a full 1% down in technology, almost a full 1% down in financials. And over here, consumer discretionary, industrials, communications, all of these down about 0.5% to 2/3 of 1%. So again, think about the numbers that I'm quoting here. Think about these different colors of how things are looking from the open, and ask yourself that question. What type of selling do we have? Again, I maintain, I think it's relatively orderly. I think the market is taking some froth off the top. It needs to do that. It's absolutely healthy. But there's nothing here in the markets, neither technical nor in this type of selling that I'm seeing that is systemic. And we know it's not systemic because there hasn't been any news catalyst that would drive it, right? The Fed didn't like raise interest rates in a big surprise overnight, or there wasn't any natural disaster or whatever, right? So there's nothing really systemic here that would be affecting the whole market. It's just that that technology got a little bit overheated and it's moving down a little bit. Some of it's going into other sectors, but like we've been saying, we're starting to see more across the board selling as the week developed, right? Let's move over to this next graphic right here, because I just wanted to point out this is extremely nuanced, but this is the graphic at the end of Thursday. And I just wanted to point out, like up here in the upper left, you see the breadth, that's 3.4 to 1 negative on the NYSE and 2.5 to 1 negative on the NASDAQ. Again, relatively orderly. When the market has big trending days lower, you often get that breadth. If all the sectors are selling, you can see that breadth being 10 to 1 negative, 15 to 1 negative when there's like real panic. And then I also just want to point out real quick here, especially on the bottom, this is your iceberg tick. This is Wednesday and Thursday of this week. Thursday was the only time we got a little bit today, but I just want to point out how Wednesday, remember if you recall, I was saying that the selling was more rotational on Wednesday. Notice not a single minus 1,000 tick on the New York Stock Exchange. And then on Thursday into the close, you got like 7 or 8 or more of the minus 1,000 ticks. They were really kind of banging it down there. So it was definitely a little bit weaker. And obviously the weighted AD, which you can see the difference between where you were the day before and how the histogram was building out to the bottom. This is the pictorial representation, so to speak, of those 11 sectors. Basically, whatever these are doing here from the open, that's converted into this histogram basically, and that's building every 5 minutes, each bar either above or below zero. You can see the sort of build to the downside. That's often one of the best confirmations of a market that you want to sort of remain short of, is whenever that weighted is sort of building to that downside. But again, still a little bit of rotation in the market. I don't see the all-out panic here just yet. We'll see if that changes, but that's basically the situation under the hood as it stands right now. I wanted to do a sector spotlight this week, and you should be able to guess already which one it's going to be, because we've alluded to it a lot in this program in terms of what's driving this market lower right now. So it's got to be technology. I wanted to talk about XLK in terms of the sector watch this week. So XLK is, just to refresh your memory, is the largest grouping in the S&P 500. It is now 32.4% of the index is technology, and we use this XLK ETF to sort of track that. Let's move over to the next slide here. I want to show you just something here in terms of the components and weightings, and also to give you a heads up on earnings dates here, because obviously tech earnings are super important. You can see we're starting here with Microsoft on July 30th, and all these earnings are happening mostly in August and early September. But the real takeaway here is the fact that if you look at the percentage weight of these top 10 stocks in the XLK, notice that the top 4 here, that's literally more than half. That's about 51 to 52% if you do the math between just Microsoft, Nvidia, Apple, and Broadcom. So the top 4 stocks here in the XLK make up almost half of it. And that's important to note, because that also speaks to everything that people have been complaining basically about this market for a while, of how narrow this rally is, right? Because generally XLK is driven by 4 stocks, and then XLK inside of the S&P is 32.5% of the S&P, right? All technology. So you've got this like 4 stocks driving the group, and then the group itself is like a third of the broad market. Now that we have a better idea, of course, of what makes up the XLK and its weightings, etc., let's move over to the chart for a second. I want to just take a look at this daily XLK, because it is so important in this particular market. As we've been saying, very, very heavily weighted in the S&P, and we know that technology is a big driver of what's going on right now in this market. So I've just got a couple of takeaways from it. You do have kind of a flat bottom here where there was multiple supports, about 3 supports there. Tech has broken that. Also, this secondary trend line, it's not really a primary, but it is a pretty important one. Secondary trend line has been broken now, and we've got a primary coming in right in here at about the 215 level. So I want you to kind of mark that off on your charts. If the selling was to intensify, more than likely all these tech stocks are going to find a bottom when the index, when the group as a whole comes down to about that 215 level. So basically, keep your TA simple, as I'm always saying. I wish I could tell you if this is going to stop somewhere in the middle, turn back around or not, but that's what the markets are all about. There's no way of knowing that. All we can know is that prices that are in motion tend to stay in motion, and also once trend lines are broken, prices tend to move, in that direction. So right now we do have a trend line break, and again, ultimate target would be about 215 in the XLK, but we'll have to wait and see if that happens. As many of you may be thinking, should I even be trading at all in this market as things have gotten a little bit squirrely? I figured it'd be a good time to do should I do this trade? A couple of reasons, not only for the educational aspect of it, because I like to look at different option spreads that people suggest to me and sort of critique them, but also because the stock in question that the person who emailed in, or rather in this case it was in my weekly options room, the stock that was suggested is one that I really like from a technical basis on a chart pattern, and it's one I'm going to be looking at long when I get a signal that the market is turning. Let's take a look at what this gentleman was asking in my room recently. Keith NYC says Adobe has been consolidating around its 61.8 fib level from its Jan high. Play for a breakout up to 595. Can we buy to July 26th expiry, so for next week, call broken wing butterflies, and he's choosing the strikes 585, 595, 615. So that's a BWB because obviously between 85 and 95, there's 10 points, and between 95 and 615, there's 20 points. So obviously that's going to trade at a discount to a regular straight butterfly. And he wants to turn this whole thing into what I call a risk reversal, which I love, which is simply where you sell put premium in order to finance that call structure. And in this case, Keith is saying sell 4, so it would be in a 2-to-1 ratio, basically sell 4 puts for every 2 call structures that you buy of the 525 puts. And at the time when this message was posted, the total package was marking about a 40-cent credit. So this has a lot going for it in terms of it's the type of structure that I like. It's esoteric. It's utilizing the net short structure on the call side with the BWB, and then whatever debit there is in that BWB, it's erasing it through using that put. However, I don't like the strikes that are chosen here. So this is not a trade I would do, but as I was saying a moment ago, I love the chart. So let's take a look at the technicals in Adobe, and I'll tell you exactly why I'm really liking it a lot here. Remember what we were just showing earlier on this screen of what the S&P daily looked like and the NASDAQ 100 daily looked like. Recall that we've had relatively strong selling on Wednesday, Thursday, and Friday of this week, and those days were lower low, lower low, lower low, and those days were also taking out the 8-period exponential moving average and taking out the 21, right? We know that the broad market as a whole is below those moving averages now, especially the NDX, which has really crashed a bit further. And what's interesting about this is look at this particular chart right here. This is Adobe on the daily, and again, here's your 8 EMA, the dots, which you've taken out, just only on Friday. Friday was the first day, really. I guess Thursday you closed a little bit below it as well. Friday is here, but look where the support is. This green line here is the 21. So this is in sharp contrast in terms of what's going on with this stock and what's going on with the broad market. And I found that there's plenty of pockets of strength in this market like this, and these are the types of names that you want to be looking at when that turn does occur, because what stays strong here in the sell-off is going to be strong, as it's going to be probably even stronger than the market when things start to turn around. So I must say, I do like the chart. Great selection here in terms of what to look for on a bullish risk reversal, but I don't really like the strikes as much. So let's take a quick look here, if we could, at what I would suggest to do on this Analyze tab right here. Let's go over to the strikes here. One problem that I have with what was suggested was simply the fact that if you look at the premium structure here, as you get above, say, 595 up into this area, right kind of where Keith wanted to start the spread, right up in these areas, there's not a lot of premium here, and I also feel like it's just too far for the stock to run in order to get up there. You can see the current pricing right here is about 551, so it's kind of too far to go, I think, before that long call starts to kick in. So my idea, and don't get me wrong, this pricing may be a little bit different because obviously when the market closes, all of a sudden these spreads tend to widen out, when the market's closed. But I like a structure more of possibly selling 530 puts for about $1 or more, and at the same time taking that premium and putting it into a BWB here that starts a bit lower, meaning putting into a BWB that's 565, 580, 625, therefore giving you a little bit more exposure to a lower call structure around 565 that'll turn into something faster than picking those strikes that are somewhat higher. And if we go back to the chart here, why did I say that I would be okay with being the short puts at the 530 level? Well, that's actually pretty simple, because notice that this line here, which was the prior high, that's coming in at around that 535 to 540. The trend line support is much lower, but I think that here on a stock like this that's showing some relative strength, you're probably going to be okay selling those puts there. And if you get some sort of adverse, very emotional move down to that area, you can always roll. And if you need to roll, you're probably going to be rolling right underneath the trend line where it may be a little bit safer, right? So overall take here is I would not do the trade the way that Keith suggested it, but I do like the stock. I think it's one to look for. And this is especially, like I said, why I wanted to choose his message to share with you in a should I do this trade segment here, because this is a stock that I think people should be looking for on the long side, as it has not been selling off with the market at all, catching support at that 21, whereas we know the market is a lot weaker right now. As always, wrapping it up with some very actionable and specific content. We're going to do a number one draft pick here, which this week is a company called MicroStrategy. And if you haven't heard of this company, that's okay, because if there was ever a company where it doesn't really matter what they actually do, it would have to be this one. MicroStrategy is essentially a software company, and they operate in a space called business intelligence. If you don't know what that is, join the club, because I really don't either. And like I said, it really doesn't matter. And the reason that it doesn't matter is because MicroStrategy does about a little bit under $500 million a year of revenue, but their market cap is over $31 billion. And the reason for that is simple, is because some time ago they decided to lever their whole balance sheet and all the cash they have to Bitcoin. They've taken basically all the money they have on their balance sheet, thrown it into Bitcoin, and even sold some stock and bought more Bitcoin, and issued some convertible bonds and bought more Bitcoin. So basically this is a stock that is like a proxy for Bitcoin, and it tends to move more than Bitcoin. As I'm speaking today to you, today on Friday, July 19th or 18th? Thank you. July 19th. Had to ask my cameraman for a second there. As I'm speaking to you today on Friday, July 19th, Bitcoin was up about 5% today, but MicroStrategy was up 12. So this is really sort of an amplified version of what goes on in Bitcoin, but it does have a relatively wide spread. It is relatively difficult to trade, but there's lots of different things you can do with this stock, because it also has very, very high implied volatility. Let's move over here to the chart for a second. I want to show you also specifically why I'm targeting this stock for the number one draft pick today. Bitcoin has not yet done what I expected to do into the end of this year, and probably into continuing that rally into the middle of 2025, which is to break out above the 73,000-ish level, which we know was the prior resistance in Bitcoin. But MicroStrategy, as I was saying, is taking off to the races already, and it did something very, very interesting today that really made me stand up and take note, and that was the fact that there was this resistance here around the 1725 to 1750 area, and you can see the stock closed today all the way up at 1778.5. And again, this is happening when Bitcoin is really just sort of in the middle of its channel and has not yet even gotten close to its highs. I believe that if Bitcoin does what's expected, the move in this is going to be so amplified, and you are easily going to see a MicroStrategy that is going to be way north of $2,000 per share, okay? Now, that's one thing just on the stock. It gets interesting. I would say if you're going to trade this stock, go very small. Be very, very careful. I am starting to build a position in this very, very slowly, but as you can see here, it's 50 shares right now. I'm building it very, very slowly. I would like to have about 500 when all is said and done, once I believe that the real move in Bitcoin is happening. And again, I expect that the move in the stock could be north of, say, 500 points, maybe even 1,000 points. I think it's going to be a monstrous move. But you can see just how much the stock moves just on the 50 points, right? You can already see there's a decent P&L just because the moves are so large. But that, I think, is not really the real story. Again, I do think there's a play here in equities, which makes sense. Again, keep it super small. I have traded this stock before with as little as 5 or 10 shares and made solid money. I mean, this is a stock that can move $150, $200 in a day. So you don't really need big share size. But as I was saying before, I think what's really interesting here is the options, which is just fascinating here in terms of how high the implied volatility is in these particular premiums on MicroStrategy. So looking at this options chain on MicroStrategy, the first thing you have to notice is the circled area there on the far end of the screen. Almost 100% implied volatility. These are the types of IV numbers that you generally only see in regular stocks around earnings releases, but this stock has this type of IV all the time. And if you are an astute options trader, you should love that, because remember, high IV means one thing: complex spreads are cheaper. This is the type of stock, if you want to capture a larger move, you don't really have the gumption to put on some shares. There's a little bit too much risk there. You'd rather have a more defined risk. This is the way to go. You've got 100% implied volatility. And look at some of these premiums here on the call side, which are well above where we are. We know that we're closing today around 1775, 1778. Look at these premiums here, about 200 higher. I mean, there's just plenty of it here. $27 by 33, roughly $30, a couple hundred higher, and this is only going 1 week out. So this gets very, very interesting. Play around with this a little bit and use some of the strategies that I teach on this show and I teach in my weekly options room. Look at some broken wing butterflies. Look at some unbalanced butterflies. Look at some reverse mullets. Look at the types of spreads that you can put on, and I think you'll see that they are really relatively cheap in terms of how much you'll pay for premium and how much you can actually get at payout if you can, if the stock actually ends up where you expect it to be at the end of the week. Because remember, whenever the IV goes way up, complex spreads get cheaper. It's going to take you a little bit longer to get paid because that extrinsic value is so high and it's going to stay in the spread. But when Friday rolls around, and if it's where you wanted it to be, I think you're going to be pleasantly surprised. So remember MSTR, both for shares as Bitcoin moves higher, keep it small, build your position, be super careful. Remember, this is very, very volatile, but also the options are really a good play here with that 99% implied volatility. Lots of different spreads you can do, and you can get real creative with it and just have some fun with it. And that's all for this week's show. Thank you so much for hanging out with me a little bit this weekend. Big announcement, there will be no weekend edition next week, so keep that in mind. We're going to go on a short hiatus, but we'll pick this up in August when we return right after that. Also, if you want to trade live with me, and this is really important as I get to speak to you here in this forum only when the markets are closed and only once a week. If you want to see how I comport myself when the market is actually open, hit the link in the description below. You can take a $7 1-week trial to my room, the Weekly Options Advisory, and I'd love to see you there. All right, beyond that, also, if you can, hit the little bell icon and the like and subscribe buttons on this video so that you get notified when we post new content through our Shadow Shorts program every night. Myself and my team from Live Trading Suite putting out videos every night. And also that does help the channel. As you can see, we're trying to march up to those 100,000 subscribers, so we're kind of excited about that. All right, markets, a little bit stronger selling than we saw recently. Some of that rotational aspect in the markets is starting to fade, and it feels like we're getting some selling more across the board this week. But that being said, the tempo is still relatively slow. There's relatively low emotion. I'm not seeing the big panic. As I was saying, I'm not seeing anything really systemic here that's going to take the whole market down in a big way. Now, as my mentor in the market profile, Mr. James Dalton, always taught me, the wagon wheel runs fastest at the bottom of the hill. So could there be a scenario in the next week or so or whatever where we have the usual sort of little bit, and then all at once? Certainly, could be, and I'm ready for that. Just be aware that that is a scenario, but right now, you're not seeing that, and I can say all you can do is go on the information that you have right in front of you. Okay, not only in the markets selling off in a relatively orderly manner, but there's also some pockets of strength out there. I showed you a chart of Adobe, Avgo, Broadcom is another one that just comes to mind right off the bat. That one is pretty strong. There's a lot of stocks out there that are looking better than the NASDAQ 100, and those are the ones that you want to be looking for when you get a signal that the market turns around. Those stocks are going to be strong, all right? Coming at you from Los Angeles, California. Again, thanks for hanging out with me. I wish you good trading and good night.